Okay, let's just jump right into this explainer and tackle a question that completely flips standard financial advice on its head. Do the ultra-wealthy really avoid debt like mainstream gurus are always telling us to? Well, we're going to dig into the actual data, the psychology behind it, and the specific tax codes to see how the highest net worth individuals are actually playing the game. It's a huge paradigm shift, so let's get right to it.
So let's start with the assumptions we hear all the time. If you listen to popular financial media, the message is pretty much always the same, right? Debt is a burden, credit cards are super dangerous, and the only real path to wealth is to pay for everything in cash. This idea gets pushed a lot, especially in debates around things like Dave Ramsey's famous National Study of Millionaires, which frequently claims that the wealthy just avoid debt entirely. But is that really the whole story?
Well, take a look at this Reddit user's question. It popped up in a discussion about that very study, and honestly, it hits the nail right on the head. People started asking, wait a second, did the study actually ask if millionaires use credit cards or just if they let the interest rack up? It's a massive distinction, and as you'll see, the actual data from wealth surveys points to a very, very different reality than the mainstream narrative.
When we actually look at the numbers, the contrast is literally night and day. About 40% of the general population holds revolving credit card debt, compared to a tiny 6% of millionaires. But here is the absolute crucial takeaway. Wealthy individuals absolutely do use credit cards. In fact, wealth management surveys show that almost 100% of high net worth clients use them. They use them for the points, the buyer protections, the convenience, the whole shebang. They just treat them as a transaction tool and pay them off every single month. So they aren't avoiding the tool itself, they're just avoiding the bad debt.
This brings us to Section 1. The psychology of debt and opportunity cost. To figure out why this massive gap in behavior exists, we really need to look at the academic research on how our net worth completely rewires how we process financial risk.
It turns out, having money physically alters how your brain views debt and assets. Just look at this landmark study out of Princeton University by Abigail Sussman and Eldar Shafir. They revealed how our financial baseline dictates our entire perception of wealth. They basically found that a person's net worth acts like a psychological background filter, completely changing which financial features stand out to them.
Take the profiles of Mr. Blue and Mr. Green here, for example. The researchers found that people in the black, meaning they already have a positive net worth, obsess over lowering their debt. They actually feel wealthier when their debt is low, even if their total assets are lower too. But people in the red, those with a negative net worth, well, they feel wealthier by accumulating assets, even if it means taking on massive debt to get them. It's wild, right? Because millionaires operate with a positive net worth. They aren't emotionally distracted by this desperate need to acquire assets. They can look at debt objectively, put on their economist glasses, and evaluate it purely as a math problem.
By removing the emotion from the equation, high net worth individuals overcome these standard biases by always calculating opportunity cost. The St. Louis Fed uses this fantastic example of the unseen future value of a simple coffee habit. The seen cost of a $4.49 mocha 3 times a week is about $54 a month. No big deal, right? But the unseen cost, the opportunity cost, if that exact same money were invested at a modest 3% compounded interest over 10 years, is over $7,600. Suddenly, that mocha doesn't taste quite as sweet. Millionaires apply this exact spread calculation to literally everything. If they can borrow money at 5% to keep their own capital invested and earning 10%, they are going to take the debt every single time. To them, paying in cash would actually mean losing money.
All right, moving on to Section 2, the architecture of good debt. Let's see how this psychological foundation translates into the actual practical tools used by high net worth individuals to separate productive borrowing from just, well, consumptive debt.
So the wealthy strictly reject bad debt used for consumption. We're talking things like high-interest credit cards or loans for depreciating assets like cars. Instead, they strategically utilize leverage to accelerate their net worth. Strategic debt is characterized by low, often tax-deductible interest and is specifically used to acquire assets that will appreciate or generate income. They're essentially using someone else's capital to build an asset that they're eventually going to own free and clear.
And this brings us to a massive secret weapon of the wealthy, the SBLOC, or Securities-Based Line of Credit. This is a real game changer. It's a powerful instrument that allows millionaires to access cash without interrupting the compounding growth of their investments. Think about it. Instead of selling off stock to buy a house or fund a business, which triggers a nasty tax bill and stops their money from growing, they simply use their investment portfolio as collateral for a massive line of credit.
Here's how these lines of credit actually work under the hood.
They provide highly efficient interest-only liquidity in a matter of days. Depending on how diversified their portfolio is, the wealthy can borrow anywhere from 50% to 95% of its value. The interest is usually tied to benchmark rates like the secured overnight financing rate plus a tiny spread, meaning it's incredibly cheap capital. And the absolute best part? Because loan proceeds are not considered income by the IRS, this cash is completely non-taxable. They get the money, their stocks just keep right on growing, and the tax man gets absolutely nothing.
They even use debt specifically for tax arbitrage. Here's a brilliant example of how they do it. Under current U.S. tax law, you can only deduct mortgage interest on the first $750,000 of your home loan. So for a millionaire buying a $6 million house, a traditional mortgage is terribly inefficient. So what's the play? Well, they buy the home in cash. Then they take a $3 million loan against the house and use those proceeds to buy taxable investments. Because the IRS uses what's called interest tracing rules, the interest on that $3 million is now classified as an investment expense, making it entirely tax-deductible against their investment income. They keep the leverage but completely bypass the mortgage cap. It's pretty wild.
Which brings us to Section 3, the ultimate loophole: buy, borrow, die. This entire philosophy really culminates in the most sophisticated debt framework used by the ultra-wealthy today. Let's break down this three-step engine. Step 1, buy. You accumulate high-growth assets like stocks or real estate, and you literally never sell them, allowing the gains to compound tax-deferred. Step 2, borrow. When you need cash to live your life, you use those SBLOCs we just talked about. You leverage your assets for non-taxable cash, pushing off realization entirely. And Step 3, die. You just hold the assets in the debt until you pass away and pass the entire estate down to your heirs.
Now, you might be wondering, why is that last step so absolutely critical? Well, the entire strategy hinges on this specific tax code mechanism, the stepped-up basis. Under IRC Section 1014, when your heirs inherit your assets, the cost basis of those assets is stepped up to whatever their fair market value is on the exact day you die. So if you bought a stock for $1 million and it grew to $10 million, your heir's new starting line is $10 million. If they sell it the very next day, their taxable gain is zero. This legally and completely wipes out a lifetime of capital gains liability, just gone.
Finally, Section 4, the Great Debt Divide. To wrap up this explainer, we really have to zoom out and look at the macroeconomic reality of this systemic wealth structure. Because, the way the wealthy use debt doesn't just exist in a vacuum.
Research from the University of Chicago highlights this fascinating and honestly pretty stark structural divide. They found that since the 1980s, the savings of the top 1% are actually repackaged by the financial system to fund the consumer debt of the bottom 90%. So, while the bottom 90% are using debt to finance consumption, paying those high interest rates on credit cards and auto loans, the top 1% are accumulating assets and effectively acting as the lenders. The interest paid by everyday consumers literally becomes the financial return of the rich.
As the Yale Budget Lab points out, this creates an undeniable structural distortion in our modern economy. They note that the current tax system creates what's called horizontal inequity. Basically, it deeply favors individuals whose wealth is large enough to borrow against to fund their lifestyle, compared to everyday wage earners who have absolutely no choice but to pay income taxes on every single dollar they earn just to survive.
So, I want to leave you with this final thought. Based on everything we've explored in this explainer today, from the psychology of how we perceive wealth, to the mechanics of asset-backed lending, right down to the massive tax advantages of the buy, borrow, die strategy, how does this shift your own paradigm? Is debt the terrible personal failing we've always been told to fear, or is it simply a highly optimized structural tool of the modern economy that the wealthy have completely mastered? Something to think about. Thanks for joining me on this explainer, and I'll catch you next time.